Investing basics. Investment types. Tired of losing the real value of their savings to inflation, more people are turning to investing to achieve their life goals. Achieve better financial outcomes by investing a little of yourself in the process. As Benjamin Franklin said, an investment in knowledge pays the best interest. In this video, we look at the investment options that exist to a new investor with better things to do than pore over spreadsheets. A good tip is to invest in things you understand. The range of investments is virtually limitless, but 4 fundamentals are shares, bonds, property, and cash. Here, we explain a little more about each one and how you might access them. Shares. Sometimes called equities or stock, shares are quite simple. Your investment buys a share in the ownership of a company. You may benefit from its profits via income, paid as a dividend, or capital growth from the rise in the value of your shares. Understand how the company you are considering will behave. Share prices rise and fall all the time. Owning individual shares can be risky, but investing in a range of different sectors can mitigate this volatility. Alternatively, buy a share in all of the companies that make up an index such as the FTSE 100, with a tracker. Bonds. Bonds are pretty simple too. They are a loan from an investor to a company or a government, in return for a set amount of interest, a coupon, for a set amount of time. At the end of the agreed period, your loan is repaid in full. Bonds are known as fixed income investments, because the interest paid, and the duration, are agreed when the loan is made. Bonds can be bought and sold at any time. The price will reflect prevailing interest rates, and may be higher or lower than the face value of the bond. A higher rate of interest indicates the borrower has a lower credit rating, making it a more risky investment. UK Treasury bonds, gilts, are one of the safest investments. Again, it is possible to buy a fund representing a large collection of individual bonds. Property. Property for investment divides between residential, accessed by buying to let, and commercial, accessed by property funds. Investors hope for regular income from rents, and that the value of the property will increase as well. But property is an illiquid asset. It can take months, or even years, to find a buyer. Meantime, your deposit, and any capital gain, is locked away, and rising interest rates are a threat. Those wanting property in their portfolio with less stress will find plenty of investment funds to spread their risk across a number of properties and sectors. Real estate investment trusts, REITs, are companies established to invest in property, traded on exchange. Cash. Every investor should have a rainy day fund, but the biggest threat to cash is inflation. The buying power of most savings accounts is being eroded. In theory, the only other threat to your cash is the unlikely, but not unheard of, event of a bank failing. So, you've decided investing is for you, and we've looked at the investment types to consider. In a future video, we look at asset allocation, which is purely mixing investment types, to ensure you have a good chance of benefiting from those on the up, but have your risk spread around, should markets downturn. The mix of assets you pick will depend on your appetite for risk. A slow and steady approach will typically have more fixed income, while a strategy focused on growth may have shares from a range of countries, alongside other assets. There is no right or wrong answer, there is right for you. See much more at DIYinvestor.net.